The buy now, pay later industry has taken the consumer finance industry by storm, introducing a new way for consumers to spend money on credit. Buy now, pay later offerings from companies like Klarna, Afterpay, and PayPal enable shoppers to split their payments into interest-free installments rather than one upfront payment. They've been shown to cause consumers to spend more than they otherwise would, particularly consumers who aren't eligible for traditional credit cards. Perhaps the most successful buy now pay later company is Klarna, a Swedish fintech leader that has achieved record-breaking valuations as it captured significant market share globally and domestically. When growth in e-commerce spending collapsed around the end of the pandemic in 2022, Klarna's private market valuations tanked. But 3 years later, the company's renewed growth initiatives have been extremely successful, and analysts anticipate an IPO for the company in the next year. In this video, we'll examine Klarna's volatile history as one of Europe's most valuable private fintech companies, and what its future looks like as it prepares for an IPO. Klarna is one of the most established players in the buy now pay later space. It was one of the first companies to offer consumers short-term installment loans on everyday purchases, and remains one of the most popular. According to a survey from late 2023, just over 20% of buy now pay later users use Klarna regularly, putting it neck and neck with competitors like Affirm and Afterpay. PayPal, with its brand recognition and pre-existing merchant relationships, is the most used provider, with over 2/3 of buy now pay later users using PayPal's offering frequently. PayPal only started offering buy now pay later when it launched its Pay in 4 program in 2020, after it saw the huge growth potential in the space and wanted to get a piece of the action. Klarna's business model, and indeed every buy now pay later business's business model, revolves around offering short-term, interest-free loans to consumers for online and in-store purchases. Shoppers can do their shopping in the same way as they did before, but when it comes time to pay for their purchase, they can choose Klarna as their payment method. When they do this, Klarna pays the merchant upfront for the full purchase price, but the consumer only pays the first of 4 equal-sized installments. They pay the remaining 3 installments to Klarna every 2 weeks over the following 6 weeks. This way, the consumer can make their purchase immediately, but spread out the payments into more digestible amounts over time. This has made Klarna and other buy now pay later products incredibly popular among younger consumers who feel budget constrained or want to buy products they might not otherwise be able to afford. So why exactly is Klarna so appealing to consumers? First is its simplicity. Compared to traditional credit cards, Klarna doesn't bury users in complicated terms or hard to understand interest rate schedules. The proposition to the consumer is very simple. You just pay 1/4 of the purchase price every 2 weeks for the next 6 weeks. No interest or fees to worry about. Additionally, Klarna's slick app interface gamifies the shopping experience and makes it easy to make further purchases from partnered retailers. But there's a flip side to this convenience. Researchers have found that using buy now pay later makes consumers perceive the cost of their purchases as more trivial and feel like they have greater control over their budgets. This psychological effect has been shown to cause consumers, especially financially constrained consumers, to buy more stuff. In a recent study, 2 marketing professors observed hundreds of thousands of shoppers over an extended period of time to determine the effect of buy now pay later on how much money they spent. They compared the consumers' spending patterns from before and after adopting buy now pay later schemes. The researchers found an immediate increase in spending among those consumers who adopted buy now pay later, by as much as 25%. This increase was not observed by those who did not use buy now pay later. In addition to its traditional buy now pay later interest-free installment loans, Klarna also offers more traditional financing options to consumers as well. These offerings are more similar to credit card loans with monthly payment cycles and also carry interest rates similar to credit cards. The terms of the loans vary depending on several factors, including the timeline of the loan. Most of their loans are 6 months or less, but some can be up to 36 months. The interest rates on these loans are high, sometimes as much as 33%. That's even higher than many credit cards. Financing from Klarna to cover discretionary spending is almost never a financially favorable option, and is disproportionately used by people who cannot get credit cards. Klarna does make some net interest income from the interest-bearing loans, but it only represents a very small fraction of their total revenue. The bulk of Klarna's revenue comes from a business model that is not very transparent to the everyday consumer. To Klarna, the consumer is not actually its customer. Its buy now pay later and financing products provide consumers with flexible payment options that help increase the amount of money that people spend. This is very favorable to Klarna's retail partners. These retail partners pay Klarna to provide their buy now pay later products to their consumers, and this is how Klarna generates the majority of its revenue. Klarna earns around 85% of its revenue from these merchant fees. The increase in sales that merchants see as a result of offering Klarna's Buy Now Pay Later offering makes it worth it for them to pay these significant fees. On average, for every $100 spent via Klarna, the merchant pays Klarna about $2 in fees. In 2023, Klarna's fee-based transaction revenue grew 29% year over year, showing that its retail partners continue to see significant value in this arrangement. This is also very high quality revenue for Klarna, because due to the very short durations of the Buy Now Pay Later loans, an average of about 3 weeks, their interest expense and credit losses are incredibly low. For the full year of 2023, Klarna's company-wide credit losses were less than 0.4% of total payment volume. Their total funding costs were even less. With this capital-light, primarily fee-based revenue model and efficient underwriting, Klarna has been able to maintain gross margins of nearly 50%. Add the fact that the company is growing fast and highly scalable, and this has made the company an extremely attractive business to investors. Rumors first started circulating around a possible public listing of Klarna shares back in the late 2010s. Between 2010 and 2021, Klarna raised billions of dollars of capital through a series of private funding rounds that constantly increased its valuation. The company's meteoric growth earned it unicorn status, and made it one of the favorite companies to cover among the tech and business media. Early backing from prominent investors like Sequoia Capital and DST Global supported the company's expansion across Europe and into new markets, including the United States. By 2019, Klarna achieved a valuation of $5.5 billion with a $460 million capital raise. In 2020, amid a surge in pandemic and post-pandemic online shopping and digital payments, Klarna raised another $650 million, pushing its valuation to $10.65 billion. The momentum peaked in June of 2021 when a $639 million funding round led by SoftBank's Vision Fund 2 catapulted Klarna's valuation to $45.6 billion. This investment made Klarna Europe's most valuable private fintech company. Around this time, there was widespread speculation that Klarna would go public, either by IPO or direct listing. It had achieved massive scale, was growing fast, and already publicly reported its financial results each quarter. According to CEO Sebastian Siemiatkowski, an IPO would be the logical next step for a company like Klarna. And yet, the IPO never happened. Siemiatkowski thought that the economic environment was too unstable at the time, mainly due to the Chinese real estate collapse. Additionally, with Klarna's private market valuations constantly increasing, he felt little urgency to go public. The company chose to instead focus on growth as a private company. 2021 proved to be Klarna's last chance to go public at such high valuations. After the Fed began its interest rate hiking campaign in 2022, valuations cratered across the market. But there was perhaps no area hit harder than hypergrowth tech, particularly in the private markets. In July of that year, Klarna was forced to raise an additional $800 million at a valuation of just $6.7 billion, an 85% decrease from its prior year's valuation. For the next 2 years, Klarna was mostly inactive in the capital markets, as the entire tech industry waited for interest rates to moderate and the funding markets to recover. In November of 2024, Reuters reported that Klarna had begun the process towards an eventual IPO in the US. The Fed had just cut its target rate by 50 basis points the prior September, signaling a reversal in the rate hiking campaign. Additionally, if Klarna wanted to ramp up its growth in the face of mounting competition from the likes of PayPal and others, it needed more liquidity. As e-commerce generally slowed in the years since the pandemic subsided, people returned to in-person shopping, and Klarna's growth slowed to a near halt. Gross merchandise volume is one of the most important metrics for Buy Now Pay Later companies. It measures the total amount of money flowing through Buy Now Pay Later offerings. From 2020 through 2022, Klarna's gross merchandise volume increased from $53 billion to $88 billion, but the majority of that growth occurred prior to 2022. In 2022, it actually decreased slightly. In 2024, however, Klarna seems to have been able to return to significant growth. This has allowed them to post their first quarterly operating profit in years, and they look about in line to report a break-even 2024 on an operating basis. One significant contributor to their recent growth has been their partnership with fellow fintech unicorn Stripe. Stripe is an online payment processing service that allows merchants, particularly small online merchants, to accept payments from customers. Stripe is a private company that does not disclose its operating or financial metrics publicly, but estimates from CB Insights have their total payment volume above $1 trillion annually. Klarna has been integrated with Stripe in a very limited capacity since 2021, but since the fourth quarter of 2024, they've implemented a new integration with Stripe. An integration between a payment processor like Stripe and a buy now pay later company like Klarna means that when a consumer is making a purchase on a website that uses Stripe, instead of putting in their credit card to pay, they can use Klarna's buy now pay later installment loans instead. With the limited integration, not all purchases gave the customer that option. But despite this, Klarna's chief commercial officer said the company has added new merchants at double the previous rate since the launch. In January, Stripe and Klarna announced that after seeing how this new integration has performed, they have agreed to significantly expand their partnership. Now, Stripe merchants will be able to offer Klarna as a payment method on their e-commerce sites in 26 different countries. Merchants will also be able to perform experiments like A/B testing and monitor conversion rates in real time with the Klarna payment method. This partnership is huge for Klarna. Stripe processes much greater payment volumes than Klarna, so it represents a huge opportunity to reach new consumers and merchants. And the fact that Stripe chose Klarna over other buy now pay later providers is further indication that the previous, more limited integration has yielded positive results. Throughout the 2010s up until the e-commerce pullback after the pandemic, Klarna was able to continually raise money at ever-increasing valuations. But after its growth stopped in 2022, its valuation tanked by 85%, from a peak of $45 billion down to $6.5 billion. The company hasn't raised a significant round since then. As it has returned to growth, however, speculation resurfaced that the company would do a US IPO in 2025. Bloomberg reported that the company was seeking a $20 billion valuation, which would be 3 times its last significant publicly disclosed private valuation. In efforts to maximize their potential IPO valuation, Klarna is reportedly seeking buyers to offload their portfolio of consumer loans. As of last quarter, the company held $8 billion in loans to the public. Selling off some or all of these loans to investor groups could fund more loan growth in the future. These loans could then be sold to fund even more loan growth in a money-making cycle. Additionally, holding fewer loans on a balance sheet is generally more attractive to public market investors. Banks and other traditional lenders tend to fetch relatively low valuations on their earnings compared to the broader market. A capital-light business built around transaction and fee revenue, in contrast, has much better margins, risk profile, and potential for growth, and accordingly deserves a higher valuation. As an example, consider the fintech company Upstart, which is also involved in the consumer lending industry. Upstart's business model was to provide AI-based credit products. Specifically, banks and other lenders can use Upstart's modeling techniques to evaluate the creditworthiness of a potential borrower, replacing traditional credit scores. This system supposedly models credit risk better, resulting in the ability for lenders to make more loans to borrowers who would otherwise be judged to not be creditworthy. It went public during the SPAC mania of 2021 and quickly skyrocketed in value because of its high growth and high margin fee-based revenue structure. Leading up to its IPO and until around 2022, Upstart's fee revenue grew massively. It grew from $88 million in 2018 to $801 million in 2021, almost a 10 times increase. But as their growth started to slow around 2022, when interest rates rose and lending plummeted, the company started holding more and more loans on its own balance sheet. Taking on loans onto their own balance sheet helped support their fee revenue and allowed them to supplement it with interest income. However, it also bloated their balance sheet and exposed them to credit and interest rate risk. Investors hated this, and Upstart's stock collapsed in 2022 and has never recovered. Klarna's situation is different in that their payment volume and resulting fee revenue appears to have begun growing strongly again, so they don't need to pursue growth via interest income from loans. Additionally, the market for buy now pay later loans is newer in the US than other parts of the world. There is a lot of uncertainty around how to value these loans and what the risk profile is. For all of these reasons, it's in Klarna's best interest to make sure they don't accumulate too many of these loans. The other major factor in Klarna's favor ahead of their potential IPO is their profitability. Unlike most tech unicorns, Klarna reported a small operating profit in its most recent quarterly report. Klarna had actually been profitable for much of its life, but only started making losses in the late 2010s as it ramped up its growth initiatives. Their return to profitability was made possible in large part by extreme personnel cuts. In 2024, Klarna started using generative AI to handle a lot of its customer service operations. They now say that their AI customer service agents can perform the workload of 700 human customer service agents. It has also apparently reduced the average time to resolution significantly, suggesting that the AI agents are actually at least as good as the human agents on average. Klarna has been able to reduce their total workforce by 1,200 people as a result. So far, the quality of Klarna's customer service doesn't seem to have taken too much of a hit, with a relatively respectable 4.1 star rating on Trustpilot. It's about in the middle of the pack among its peers, with Afterpay having a higher 4.7 star rating, but Affirm having a very low 3.1 stars. As they've rolled out these AI agents, along with their growing revenue, their quarterly net income has risen each quarter in 2024. It's been a roller coaster past 15 years for Klarna. They planted the seeds of the buy now pay later industry, which has now grown into the most impactful new trend in consumer finance. Buy now pay later is a controversial product that has been accused of enabling financially strained consumers to spend more than they can afford. But if the current trends continue, Klarna might end up as one of the biggest beneficiaries. Alright guys, that wraps it up for this video. What do you think about Klarna? Let us know in the comments section below. In the meantime, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.